Hey everybody, Corey Schrader, Black Creek Wealth. Welcome to another Trading Tip Tuesday. Today I'm going to be talking to you briefly about the old crossover approach. So, big thing to just take note of, I say this ad nauseum, but follow your systems. If you're going to be trading crossovers, if you're going to be trading volume, if you're going to be trading many different indicators, just make sure you're following your actual rules and don't feel like you're missing out because, as I tell all my traders, there's always another trade. It may not be in this index, but it could be in NVIDIA or Google or Apple, but there's always another trade. So let's go ahead and jump into it today and keep it relatively short. So today I'm going to be talking about the exponential moving average crossover. So what you can see here is I've gone ahead and I've isolated the S&P 500 index. Remember, gray is your pre-market, black is your current day or the trading day, and then again back to pre-market or after market. So when you get into this, a couple things to know. First and foremost, there's a difference between a simple moving average and an exponential moving average, and it all comes down to the way it's calculated. So a simple moving average, let's say it's five period moving average, or simple moving average, just takes those 5 periods, adds up the prices, divides by 5, and that's what your average price is, your simple moving average. Your exponential moving average is a little bit different in its calculation in that it weights the current price heavier than, let's say, the fifth period. So if you go and you look at it, okay, go back to five. Let's say it's one, two, three, four, five. Well, that last weighting, that last price will have a higher weighting than the first price in the actual series of data. So the biggest thing to know with any moving average, all you're looking at is the price now higher than it was back again in this specific instance 5 periods ago. The reason why you use exponential over simple is because exponential is weighting the current data more heavily. So if there's some sort of pivot or movement, you want to be ahead of it because again, our goal is to be ahead of all the other traders out there because we know what they're going to do. So if we can be one step ahead of them and then get the rally or the tailwind from them, that's why you use an exponential over a simple. So when we get into this crossover strategy, you can see it here. This is actually today, since it's after 4. And certain traders will look at this and say, okay, let's keep it simple, right? I'm going to use this yellow line here, which is a 20 period moving average, versus the blue line, which is a 9 period moving averages. And these are common moving averages that most traders or retail traders use. So you could argue and say, listen, anytime this crosses over, and you can see the prices up here, you'll see 9 period, 20 period. Anytime this 9 period is higher than the 20 period and volume is a little bit elevated, you can see it's a little bit elevated here, that I'm going to go ahead and jump in and just ride this wave up. As you can see today, it would have worked. Look at that. I would have gotten in at 638, would have gotten out end of day around 640. So you would have had a little bit of a gain there. Not too bad, right? So let's look at a prior day. Let's look at a couple days, right? Okay. Let me remove my levels here. Remove, remove. I don't want to sidetrack us here. So you go back to yesterday, right? Or this was back on Friday. So you go in here and you're like, oh, no trade, right? Okay. I'm just gonna have to wait and can't trade that day. Okay, that sucks. All right, let's go to this day. All right. Well, you can see pre-market, everything was kosher, and then uh-oh, now it's gone under that 20 period moving average. It tries to fight above it here and gets close, but then eventually reconciles and comes back of it. So what you got to watch out for with this kind of strategy is this whipsaw. Let's say, hey, you're like, hey, if no matter what happens, if the 9 periods over the 20, I'm going to buy into it. Well, look at what would have happened. It would have absolutely corrected. Emotion might have kicked in and said, uh-oh, I made a wrong trade, and I would have sold as soon as it crossed over. So that's why you have to have confirmation tools that just back this up. Some people use volume, some people use average daily volume, some people use RSI, some people use MACD. I use a combination of different things, but to keep it simple, you could literally just trade off of this and just ride these waves. So that's all I'm going to talk about today because it's been 5 minutes and I don't want to hold you up too much. But again, if you're looking at a crossover strategy, this is something you could potentially jump into. I use it as part of my bigger strategy with confirmations, and I will show you those confirmations next week. But thanks for tuning in. Have a blessed day. If you have any questions, feel free to comment, like, and share. And look forward to our next conversation. Have a great day.